Let's look at liquidity risk, the silent killer. What is liquidity risk? Liquidity risk emerges when an institution cannot meet its cash obligations as they fall due or can only do so at an excessive cost. But the risk has two different dimensions. Number one, funding liquidity, ability to raise cash, like what I just described now. For instance, if you go with an individual that's a real estate investment and does not have the ability to meet some of their cash obligations, to raise that cash, they might need to go into borrowing and use their assets as collateral against the borrowing. The second element is market liquidity, ability to sell assets without significant price impact. Now, if the person lending them the money understands that they are in a situation where they need to meet their cash obligations, the costs might be higher because they know they need the cash. They are not liquid. So that is continue to use the same example. And that applies also in the market where a business has a lot of assets, but they're not able to meet their cash obligations. Liquidity crisis can develop rapidly. An example is Northern Rock and Lehman Brothers in the 2007-2008 crisis, and Silicon Valley Bank more recently in 2003, I think it's 2022, 2023, I believe, all failed primarily due to liquidity runs rather than insolvency. When depositors lose confidence, and we'll look at reputational risk later, this is a good example of reputational risk, even fundamentally sound institutions can collapse within days.